Fundamental Analysis Part 8, Ratio Analysis. In this tutorial we will be analyzing few important profitability ratios, liquidity ratios and debt coverage ratios. We will be analyzing few key ratios of Technocraft Industries Limited. The following information has been extracted from moneycontrol.com. Firstly, under profitability ratio, the important ratios are net profit margin ratio, return on equity and return on capital employed. What is net profit margin? Net profit margin is a ratio that indicates for every 1 rupee sales of the company, how much net profit does the company make. It is obtained by dividing net profit by the total sales. In this example, the net profit margin is 9.4%. This means that for every 1 rupee sales the company earns 0.094 rupees as net profit. The reasonable net profit margin varies from one sector to another. Next, under profitability ratio we have return on equity. What is return on equity? Return on equity measures the rate of return on the shareholders' equity or the capital. It is obtained by dividing the net profit by the shareholders' equity. In this example, the ROE is 15.25%. This indicates that the return on shareholders' equity or return on company's capital for the year is 15.25%. Return on equity above 15% is considered to be good. Lastly, under profitability ratio we have return on capital employed. What is return on capital employed? The return on capital employed is a ratio that shows how well a company is using both its equity and debt to generate the return. This is obtained by dividing EBIT by the capital employed. Here capital employed equals shareholders' equity plus debts. In this example, ROCE is 19%. This indicates that the company return on capital plus the debts used in operations is 19%. ROCE above 15% is considered to be good. Here we come to the end of key profitability ratios. Next, under liquidity ratios. The important ratios are current ratio as well as debt to equity ratio. What is current ratio? Current ratio is a ratio that indicates the current assets and the current liabilities of the company. Being a shareholder of the company, one always wants the company to have more current assets than the current liabilities. Current assets are assets that gets converted into cash within a year and current liabilities are liabilities which has to be cleared within a year. In this example the current ratio is 1.7, this means that the company has 1.7 times more current assets when compared to the current liabilities. The preferred current ratio is greater than 1.5. Next ratio under liquidity ratio is debt to equity ratio. Debt to equity ratio is a ratio which indicates company's financial leverage. It is obtained by dividing debt of the companies by its equity. One needs to remember that equity is nothing but the total capital of the business. As an investor, one doesn't want to have more debt than the capital of the company. This may also lead to insolvency of the company. And if the debt of the company is more, then the interest that is to be paid on the loan will also be more. This can also affect the company's profits. The preferred long-term debt-to-equity ratio is less than 0.5. In this example debt-to-equity ratio is 0.2. This means that the company has 5 times more capital, when compared to the debts of the company. These are few important liquidity or solvency ratios. Next, under debt cover ratios, the most important ratio is interest cover ratio. What is interest cover ratio? Interest cover ratio indicates how easily is the company able to pay interest on its outstanding debts. It is obtained by dividing EBIT divided by the interest on loan. If the interest cover ratio is X, this indicates that for every X rupee revenue, the company has to pay 1 rupee as interest on loan. In this example, the interest cover ratio of Technocraft Industries Limited is 32. This indicates that, if the company generates 32 rupees revenue, then out of 32 rupees the company will be paying 1 rupee as interest on loan. The preferred interest cover ratio is greater than 5. Here are few key fundamentals to watch out for. 1. Price to earnings ratio or PE ratio less than 15. 2. Price to book value less than 1.75. 3. Book value growth greater than 7%, 4. EPS growth greater than 10%, 5. Return on equity greater than 15%, 6. Current ratio greater than 1.5, 7. Debt to equity ratio less than 0.5, 8. Interest cover ratio greater than 5. Here we come to the end of this tutorial on ratios. Please like and subscribe. Thank you.